everyone, I am Imadek Numbara from 505 class. In this video, I would like to talk about advanced accounting with the topic of business combinations. Alright, let's get started. In today's topic, there are 4 points that will be deliberate, such as number 1, understand the economic motivations underlying business combinations. Number 2, legal form of business combinations. Number 3, accounting for combinations as acquisitions. And number 4, Indonesian regulation in PSAK about business combinations. First, started with understand the economic motivations underlying business combinations. In general terms, business combinations unite previously separate business entities. Many firms can become more efficient by horizontally or vertically integrating operation or by diversifying their risk through conglomerate operations. What are those? Horizontal integration is the combination of firms in the same business lines and markets. Vertical integration is the combination of firms with operations in different but successive stages of production or distribution, or both. Conglomeration is the combination of firms with unrelated and diverse products or service functions, or both. If expansion is a proper goal of business enterprise, why would a business expand through combination rather than by building new facilities? Well, there are quite a few the reasons for business combinations. Number 1, cost advantage. It is frequently less expensive for a firm to obtain needed facilities through combination than through development. This is particularly true in periods of inflation. Number 2, lower risk. The purchase of established product lines and markets is usually less risky than developing new products and markets. The risk is especially low when the goal is diversification. Number 3, fewer operating delays. Plant facilities acquired in a business combinations are operative and already meet environmental and other governmental regulations. Firms constructing new facilities can expect numerous delays in construction, as well as in getting the necessary governmental approval to commence operations. The time to market is very critical. Number 4, avoidance of takeovers. Many companies combine to avoid being acquired themselves. Smaller companies tend to be more vulnerable to corporate takeovers. Therefore, many of them adopt aggressive buyer strategies to defend against takeover attempts by other companies. Number 5, acquisitions of intangible assets. Business combinations bring together both intangible and tangible resources. The acquisitions of patents, mineral rights, research, customer databases, or management expertise may be a primary motivating factor in a business combination. And the last one, number 6, other reasons, such as for business tax advantages, for personal income, or for personal reasons. Talking about business combination, there is a regulation that prohibits business combination that restrain trade or impair competition. It is called antitrust laws. In USA, it is regulated by the US Department of Justice and the Federal Trade Commissions, or FTC. Especially in Indonesia, it is regulated by Komisi Pengawas Persaingan Usaha, or KPPU. Now we move on to the second point, which is legal form of business combinations. Business combinations are closely related to acquisitions. It means one corporation acquires the productive asset of another business entity and integrates those assets into its own operations. The terms merger and consolidation are often used as synonyms for acquisitions. What are those? The first one is merger. One corporation takes over all the operation of another business entity and that other entity is dissolved. For example, Company A purchases the assets of Company B directly from Company B for cash, other assets, or Company A's securities such as stocks, bonds, and notes. This business combination is an acquisition, but it is not a merger unless Company B goes out of existence. What about consolidations? A new corporation is formed to take over the assets and operation of two or more separate business entities and dissolves the previously separate entities. For example, Company D is formed and acquires the net asset of Companies E and F by issuing Company D stock. Companies E and F are dissolved. Company D survives with the assets and liabilities of both dissolved firms. Next, the third point is about accounting for combination as acquisitions. GAAP requires that all business combinations be accounted using the acquisition method and record the combination using the fair value principle. The direct costs of business combination, such as accounting, legal, consulting, and finder fees, and indirect costs such as management salaries, depreciation, and rent under the acquisition method are recorded as expenses. In the other hand, registration and issuance costs of equity securities usually recorded as a reduction of additional paid in capital. I will give you an illustration to make it easier for you to understand. You may pause the video and take a note or take screen capture of it. PAM Corporation acquires the net assets of Sun Company in an acquisition consummated on December 27, 2016. Sun Company is dissolved. The assets and liabilities of Sun Company on this date are as follows. From this table, you need to pay attention to net assets balance of fair value. Here is the case number 1 when investment cost exceeds fair value. Here are the journal entries that we will record. The first one is record issuance of share and cash, and the second one is record additional direct costs. This one, the last journal entries you will make, and pay attention to goodwill account. Case number 2, when fair value exceeds investment cost. Same like case 1, you need to record issuance of share and cash and record additional direct costs. This is the last journal entries you will make and pay attention to gain from bargain purchase account. And now we are going to talk about the last point, which is Indonesian regulation on PSAK about business combination. In Indonesia, PSAK 22 is used as an accounting guideline for business combinations. PSAK 22 is the adoption of IFRS number 3 regarding business combinations. PSAK 22 is not much different from IFRS but has specific rules regarding the business combination of entities under common control or entitas sepengendali. Furthermore, it is regulated in PSAK 38. Okay, that's all about today. I hope you can enjoy it and learn something from this video. Thank you for your attention. Bye-bye.